Hello, all you lovely people out there. How are you all doing? I'm Kate Hill, and I am here to give you the best commentary about our property markets. Tina Howes is with me from SmartMove, one of Australia's leading and award-winning mortgage brokers. We are giving you a whole series explaining all things property finance, so stay tuned. And hello, everyone. I am here with Tina from SmartMove again to talk about all things property and finance. Hello, Tina.
Hey, Kate.
Hello. How lovely to see you again.
Nice to see you.
So another hot burning topic for all our watchers and listeners today. It's about using equity in your home to buy an investment property. Now, a lot of people don't know that you can do that. A lot of people do know that you can do that. They just don't know how. If you have owned your property for, let's say, more than 3 years or so, the chances are, especially recently, it's gone up in value, which means you can unleash some equity in it, which will help you buy another property. So Tina is here to explain to us how this works and just how much of this uplift in property values that we've all had, how much of that you can access and how does that work? So Tina, tell us what the process is. Tell us how it all works.
Okay, all right. So assuming you have some equity in your property, let's say the traditional model is you have an owner-occupied property.
Yeah.
Let's say it's worth $1 million. You borrowed $800,000 when you bought the property. You paid that down to about $700,000. There is equity there that you can go back to your bank and ask if you can borrow against the value of that property. Okay. Now, the overlying factor here is that from an income and expenses perspective, you need to be able to meet the bank's criteria.
Yeah.
So we'll talk through that subsequently.
Yeah.
But assuming you tick that box, then the bank will look at potentially lending you against the value of your owner-occupied property for the purpose of buying an investment property.
So they're kind of using that as like a security to you to then borrow against that.
Yeah.
And go off and buy more property. Yeah.
Yeah. Yeah. So this property that you bought for $1 million, that you've paid your loan down to $700,000, it's gone up to $1.2 million. So a misconception is, well, my loan is $700,000, it's worth 1.2, so I've got $500,000 that I can use.
Yes.
Remember when you first borrowed, how the bank wanted to go to a certain value against the value of the house? That's still the same.
Yeah.
So theoretically, you can still borrow up to 80% of the value of that property for the purpose of buying an investment property. Okay. So that might be the deposit that is required for you to buy that investment property. So if you're going to buy, say, an investment property, say, of $500,000, you want to come up with your, let's say, 20% deposit plus the stamp duty costs and so forth. You need to come up with that 25%. Potentially, you can use your home to get a loan against the home for the purpose of buying this new investment property. Okay. Now, can you go up beyond the 80%? So you can, but something to be really mindful of on the owner-occupied property. If you, say, wanted to borrow $100,000 against that owner-occupied property for the purpose of buying an investment property, but if that took you up to, say, 90% in the value of that property, you don't just pay mortgage insurance on the $100,000. You're also going to pay mortgage insurance on the first $700,000 that you owe. So it's a very expensive task. It may actually cost you, 30% of the money that you're like, we're talking 20 grand. It could very much cost you that much. So in my eyes, a smarter strategy is, and the beauty of an investment property is because there are so many markets, particularly if you're using a buyer's agent such as yourself, Kate, that you can access different markets depending on what your equity position looks like and what your borrowing capacity looks like. Whereas when you're trying to buy a home, you want to live in a certain suburb, it's a lot harder to tweak the value of how much you spend on that home. So on the investment property though, if you need to borrow up to the 90%, yes, you're going to pay mortgage insurance on that whole amount. But it's an investment loan. And if it helps to achieve that getting into the particular price point that you need to buy that good quality asset, then it can make sense. Absolutely. Okay. So that's generally kind of how it's done. When the bank looks at the affordability, yes, they will factor in the new loan on the new investment property. They'll factor in the rent on the investment property, but they will allow for a thing called a vacancy factor. So they may only take 80% or 70% of the value of that rental income. And depending on the lender, they're also going to look at the investment property expenses as well. So generally that will come out of the whole equation. So you need to be able to afford to factor in, rates, insurances, agents' fees, and so forth, and have that affordability.
In terms of income, if I can just, well, it's technically not income, but do any of the lenders factor in this negative gearing? Do they look at actual cash flow? Okay.
So there's a small handful of lenders that won't look at negative gearing. The majority of lenders will actually factor in negative gearing. So that's why it's important when you are buying an investment property to know the ownership structure. So if you were to buy in a company or a trust, there's no negative gearing. So lenders won't factor in negative gearing in that circumstance. If you're buying 50-50 between yourself and a partner, then the negative gearing will flow through to both of you. If you're wishing to put the asset 99% in the higher income earner, then that negative gearing will be factored into 99% of that higher income earner's income. So absolutely, you can do that. I know, Kate, for any of your clients, when they come to you and they want to buy a property, you will do beautiful cash flows so that they can see what the income looks like. You'll do that on an interest-only basis and a principal and interest. And it's not uncommon that net figure, might be $50 into your pocket a week or nothing in your pocket.
That's right.
It's really important to factor in, though, that when the banks are going to look at it, they're also going to say, well, yes, you're asking for an interest-only period. However, we're only going to give you an interest-only period for 5 years. Can you afford this loan after the 5 years and repay the loan over 25 years? So even though you're saying it's from a cash flow perspective, this might be the number, just bear in mind that from the bank's perspective, you may not have the ability to make the principal and interest repayments over that loan. When we structure this debt, and look, I'm a finance mortgage advisor, always talk to your accountant about the best way to structure it. But one thing that I see very, commonly is that against your owner-occupied property, you'll have principal and interest repayments. You want to pay that debt down as quickly as you can because there's no tax benefits. But for as long as we have negative gearing out there, many accountants and financial advisors will suggest to their clients for an investment property to have that debt as interest only, so that all your surplus cash flow can be used towards paying down your owner-occupied property. Okay. Now, my advice would be get your accountants buy-in on that, and don't fall into the position of, well, after the interest-only period expires in 5 years, we'll just roll that over. Because bank lending criteria change. Property values change, assessment rates change, life circumstances change. You may not, even though you've been making your loan repayments and never missed a beat, you may be forced to go back to your bank after 5 years of your interest-only period expiring, do a whole new assessment, and you may not meet their criteria. So you might be forced to make principal and interest repayments. So my advice to anyone making interest-only repayments, make those repayments still for principal and interest, but put that against your owner-occupied property. Put it in an offset account so that you have access to those funds in the event your bank says, sorry, you have to roll onto principal and interest and you can't refinance at the moment to get another term.
And look, another thing that I come across sometimes is people who, that they go principal and interest on their investment property loan because the interest rate is so much lower, and they think that they are, they're actually paying less, but all that principal that's being paid off on the investment property that should be ideally,
Yes.
into the owner-occupied property, which,
Yeah.
like you say, is a non-tax deductible debt, right?
Yes.
Anyway.
I have many clients that psychologically they want to be paying principal and interest, but they've still got big mortgages, and or any mortgage, not even a big mortgage, just a mortgage. Whether you've got 20 grand a year going off property A or property B, your overall debt position is still going to be the same.
It is.
So just be smarter. Let the tax man help you in terms of paying that debt off sooner.
I agree, and that's exactly right, because I think you will pay your home off quicker. You're going to have a better cash flow. You're going to maximize your tax deductions on the investment property. If you get more tax back, that's money that can go back into paying your owner occupied debt off. It's like you say, it's just working smarter, but it's like, people have those set ideas, I think. They do. And there's nothing wrong with paying debt down. Absolutely. We're just kind of saying, be smart about which debt you're paying down first, and how big is your home loan, and talk to your accountants, talk to your brokers.
Because I think if we go back 5 years ago, probably a bit longer than that, there actually was no rate differential in an interest-only loan or a principal and interest loan.
That's exactly right. Yes.
So it wasn't common to just get an interest-only loan even on your owner-occupied property, a portfolio loan. All of those products are out there.
That's right.
Then we saw the implementation of higher interest-only loans, and the rate differential was quite significant.
Yes.
So there was a lot of, as you say, tougher decisions to be made. But that gap has come down, and particularly investment interest only in some of the smaller lenders, there are some really sharp rates out there.
It's pretty good. It's pretty
good.
It
absolutely still makes sense to pay interest only and be steering that, but do steer that cash somewhere.
Yes.
Don't rest on your laurels.
That's right. That's right.
Another one that I come across is I've got this cash that I'd like to use to buy an investment property. And we're sitting on a home with some equity and a mortgage. So my suggestion would be, well, keep that cash, use that cash to either put into an offset account against your home,
debt,
and use debt or use equity to purchase this property. Because when you go to do your tax every year, the interest on the investment property is a tax deduction. Therefore,
it's just a slightly different scenario to what we were just talking about, but it's essentially the same thing, right? Yeah.
Because you're going to pay tax on the rent.
That's right.
Less the expenses. So rather than whatever expenses you can have on that investment is going to minimize that position, so that negative gearing or no negative gearing, if there's a profit, that's taxable income. Taxable income,
exactly. So you're paying more on your mortgage, your homeowner debt than you should be, because you're putting cash into your investment property, which then is going to be almost cash flow positively geared, and you're going to pay tax on that income. It just doesn't make any sense, right?
Exactly. And if you're not comfortable about just keeping the money in the offset account on your home loan,
pay it in.
Home loan down by 100 grand.
Pay it off.
Because your net debt position is exactly the same.
Right. That's right.
And talk to your accountant about that. Get proper tax advice.
Yes.
But in my experience,
keep a buffer if you need to. But that's right. That's right.
If you were prepared to use the 100 grand savings towards your investment property, then you should be prepared to use the 100 grand savings to pay down your own
home loan. Absolutely. Couldn't agree more.
So I would suggest always keeping some cash as a buffer. And when you're talking about how much cash you're prepared to use, be open to where that cash goes. Be clever about it.
And would you say that sometimes people can use redraw facilities for that? They can still pay their home loan down, but have redraw if necessary for unforeseen personal circumstances? Or
absolutely. Well, using an offset or using redraw is one and the same thing.
I just think that people have that perception of actually having paid the money into the loan. They've paid the loan down by a certain amount, rather than having sitting there, luring,
Yes, psychologically.
It's like that's the word.
Absolutely. I mean, that's why I'm a fan of lenders that will let you have multiple offset accounts.
Oh, yeah.
Because a lot of banks will only let you have one. But if you have a bank that will let you have multiple, then you can actually call it my extra loan repayment account. I prefer to put your money, if there's ever a remote chance that your owner-occupied residence could become an investment. I'm a really big fan of not paying down that
put it all in offset.
And most people don't know what the future is going to bring.
Yeah.
So I like the flexibility of putting the money into the offset.
Yeah, I agree.
But like yourself, if you have one offset account and you have every single life saving, extra repayments, money for the holiday, all in the one account, it is really easy to dip into one budget versus the other.
No, it is, you know, and I agree. I mean, I'm in a fortunate position on multiple for multiple reasons, but having a number of properties, all with offset accounts against them, is great, because I do have those, you know, there's one offset account that's used for that's for my tax saving, you know, when mine and husband's tax saving. One is actual saving, paying money, it's building up, paying a property off. One of the other offsets is for, let's say, for a holiday, you know, absolutely doing that, but it is still all offset, but I'm able to compartmentalize what they're for, and I'm paying principal and interest on all those loans, right? So I feel like it's a bit of a double whammy. You know, the offset accounts, I think, are, if it works for you, they are, I think it's really powerful, because you have a sleep at night factor knowing you're paying them down, even though you're building up in your offset account, it's the same thing. But you also have that buffer there, you know, should a global pandemic hit, right? And one of you suddenly not working for 8 months. Right?
Yes. And we all saw what happened with a certain lender a couple of years ago, whereby money was put into a loan as redraw, and they reduced the limits on those loans. So people's hard-earned savings disappeared. Whereas they can't take your all personal money out of an offset account.
No, that's right. So I'm I'm about as big a fan of offset accounts as you are. If it works for you, it doesn't work for some people. So again, you know, get your credit advisor to talk to you about that.
And all those things we're talking about with, you know, interest only on the investment and principal and only, that's when you have an owner-occupied debt as well.
That's right.
If you don't have an owner-occupied debt and all of your debt is investment, and you've reached that point where you don't want to purchase any more properties, then taking advantage of the lower interest rate on principal and interest absolutely makes sense. So, and even if you do want to keep buying, still doing principal and interest means that you can just gear up again against that property, because you're going to be paying it down. Hopefully it goes up in value.
That's right.
This equity loan that I've been talking about, you can go and do an equity loan against an investment property too. There are a few lenders out there that won't let you go up to 90% against an investment property to buy another investment property. So just something to bear in mind, that chances are you'll be able to go up to 80%. So in that circumstance, you really know what your plans and goals are when you are deciding on whether it's interest only or principal and interest with regards to buying investment property.
So it's making sure that, I think, that you use your equity, you know, which is obviously the point of the whole conversation. Use your equity to do something. It's a very powerful tool, especially obviously when you're buying property, because you're leveraging, you know, your return there is significant over the years. Make sure your loans are structured properly, which is kind of what we've just been talking about, right? In terms of structuring how that equity loan is put together. Now, just quickly, I know that so you would have an option of getting an equity loan in place, which would be the same bank that holds the security of your owner occupied property. So let's say that's Bank A. They make an equity loan available to you, which you can then use that as the deposit to purchase your property. Now, you don't have to go back to Bank A to do that. You could go to a different lender, couldn't you, to get the remainder of that, of the funds required?
It's twofold in that you don't have to go to the same lender, but when you go to lender A to get your $200,000 equity loan or $100,000 equity loan, that lender is going to want to understand the purpose of where the funds are going. And more often than not, it's going to need to be in conjunction with a pre-approval to purchase a property so that they can justify that you can afford that loan. Okay. When you obtain those funds against that property, then they will factor in the future property and the future rental.
Okay. Yes.
Now,
And obviously they want to keep your business, right? They want to lend you money for that other property. Yeah.
Yeah. Now, if you might get that pre-approval from that lender, and then when you actually purchase a property, you may then get a pre-approval from a formal approval from another lender if you have time to do that. A more competitive lender that is more appropriate at that particular time. I've lost my trail of thought.
Does that, well, no, because I've got another question quickly.
Oh, and I remembered what I was going to say.
There you go. Go on. No, you say that first. I'll come back to my question.
If you go directly to a bank, and you want to buy an investment property for $500,000, and you're going to use the 25%, so the 125 against your home that they already hold as security, they are more than likely going to give you one new loan of $525,000 for that new property.
Yes.
And they will take security over that $525,000 loan by both properties.
Yes.
And that is called cross-collateralization.
I'm glad you said that, because that was my question.
If you go to a broker, because the broker has your best interest first, not the banks. When you go to a bank, they don't have responsible lending best interest duties to adhere to like a broker does. They want the bank's position to be put first because they are employees of the bank.
Yes.
And that will require one clean loan. It looks nice and neat for your accountant, but your properties will be cross-secured. So when you go to sell one, you then have to go back to the bank, get the other property revalued, and that bank will tell you how much of those sale proceeds they want. If you go to a broker, they will likely take an 80% loan or a 70% even against the new property, secured solely by the new property. And that's regardless if you go back to the same bank that's got your home loan, or to a completely new lender. And the other property will be secured. Your home will be secured by that loan. And that smaller $125,000 loan in that particular example will be secured against that particular one property only.
Yes, I think that's a really important point, because it not come a cropper, but it can stop you in your tracks a bit later on if you want the flexibility of being able to sell one of the properties. I agree, because I've been there. Yes.
But be mindful when you're using equity in your home. If you then go and sell your home and you don't have a replacement property to give to the bank as security, that portion of debt that you borrowed against that home is likely to be repaid. There are some banks that will let you park it secured by term deposit for a short period of time. But that's not all lenders. And it's fiddly. Really fiddly.
Okay. Great.
Lots to think about.
There is lots to think
Make sure
about.
you have a good advisor that knows all of these ins and outs.
Yeah, and I think it's obviously about a lot more than just knowing that you can access equity in a property that you have. How you structure that loan, to me, is one of the single most important things that you can do for your future buying power. And in terms of building your portfolio, structuring your loans, it's crucial, that mortgage planning, as well as
100%
about now. It's like we keep saying every conversation we have. Spreadsheets.
Absolutely.
Think ahead, next 4, 5, 6 years.
Absolutely. It's sitting down. What are your goals and strategies? What's on the cards for the next 5 years? Because where I set you now, I want to make sure that it's with a lender that can do all these things.
Exactly.
And has the functionality. We could go for the cheapest lender, but it probably can't do this, or this. And I actually have to refinance you out again, which is just going to cost you more and more money.
See another conversation that we had using cheap lenders.
Yes.
Yes, that was a good one, wasn't it? Yes. Well, they're all good, but yes. Exactly. Okay, everyone, we will leave it there. We could obviously talk about this for the rest of the afternoon, but we won't. We'll leave it there. Thank you so much, Tina. It's always so insightful. You explain things really well. I think hopefully between us we get our points across to the lovely people out there. So we will talk to you again really soon. And for now, we will say see you soon. Bye.
Great. Thanks so much for your time, Kate.
Bye.
Cheers. Bye.
I really hope that you found all of that useful. Tina is a mind of information. She and I will bring you lots more videos explaining all things property finance. Don't forget to leave us a comment and a question. And don't forget to hit the subscribe button and also just give us a little like on the video if you are enjoying the free content. And we will see you really soon. Bye.